Well, remember when you were in your 20s and 30s and people said, start saving for retirement now? Similarly, when you're in your 50s and 60s, you need to be planning ahead for retirement. Hi, my name's Michelle. I'm a financial advisor here at Financial Design Studio, and today I want to explain how corporate executives within 10 years of retirement need to start planning for their RMDs. And there's a few things that I want to cover with you. First, what and when to think about retirement and your RMDs, then what affects your RMD, and then finally, what strategies you can use to help make your RMD more efficient. So first, let's just look at a timeline here of leading up to retirement. So for example, we're going to look at someone who's going to retire at age 65. So let's say today you're age 55, so you're 10 years before retirement. At the other end of our timeline, I want to put when we need to take our RMDs. So typically this is age 73 or after for most people. And then finally, I just want to put on here when we're planning to retire. So let's say you're planning to retire at age 65. Now, I do want to mention that we just posted an article that talks about these strategies in more depth, so you can look at that in the description below. So back to our timeline, we can think 10 years before retirement is a long time, but when we see it on a timeline like this, we can see that there's planning windows that we can act within. So what and when to think about are these ages and the things that are going to happen. So at age 73 is when your RMD typically starts for most people. And then age 65 is when you retire. And what a lot of people think is that you have less income, and you might have less income, but you don't have zero income. And that's where a lot of people think, oh, my paycheck just ends because I retired. And that's one of the key things that we're going to talk about in this next part. And so 10 years before retirement, so these 10 years prior, what's really important is that you have this 10-year window that you can actually be planning and saying, when I retire, when my RMD start, what am I going to do? So we're preparing for that because as you'll see, there's some things that can affect these ages. So let's talk about that. Secondly, what affects your RMD? So this RMD starts out here at age 73, and each year you have to start taking an amount, and typically it's around 4% of your retirement account balance. So think of your 401k that you've saved into. You haven't paid taxes on that money, but it's just been growing tax deferred. Well, now at age 73, the government says you have to start taking some money out of that if you haven't already. And even if you have been, you have to continue that. So there's this amount, it's around 4% that gets calculated each year. And that's the amount you have to take out every year. Now, what happens is that this RMD, this 4%, this is included as income. So your RMD, let's just say for an example that this is 50,000 that you have to take. It's not uncommon for corporate executives who have been saving the max into their 401k every year to have large 401ks. And so let's say that your RMD is 50,000 you have to take out in that year. Well, that 50,000 is income. So it's just as if you earned it like a paycheck. Now, let's look back at this timeline because other things that affect your RMD are at age 65, you may be starting Social Security. Or let's say you're someone who says age 70, because this is the latest that you could delay it, you start Social Security. So within this range, you also have more income starting here. And let's just assume that that income, again, for a corporate executive could be 40 to 45,000. So let's say it's 40,000. What you can see here is that as these things start, it adds income on top of each other. So income from Social Security, now we're adding our RMD. And so really quickly, just in this really simple example, we've got 90,000 of income. And what I said earlier is that people typically think, oh, my paycheck goes away, so I don't have any income. This is why when we have this RMD, we actually want to try and minimize it, but in these years leading up to retirement or in these ages after retirement. So you can see there's these big gaps here before you have to start your RMD that if your income, so for example, if we go back to age 65, our income is 40,000 here. Well, if it's only 40,000, maybe we want to take some money out of our IRAs or 401ks before age 73 so that that amount at age 73 is less. That's the idea is we're really building a timeline for our money, not just saying, okay, whenever the income happens, that's when I'm going to pay the tax, whatever that tax may be. Instead, we're saying, let's build a timeline for your money to choose what income and what amount of tax we want to pay. That's the difference of how you're looking at that. And that is really how the strategy works, or how strategies around RMDs work. So one thing that affects your RMD is the amount that you have in your 401k. That's one of the biggest pieces. And then also the expenses that you need. So as we're planning for this, some of those strategies, we need to know how much you need to spend. One of the things that a lot of people, again, when they retire, is they may not spend as much as they think they need to or used to. In this example that we have, let's assume that your expenses are only, let's use a very low number, but let's just say 70,000. If your expenses are only 70,000, but we've got income of 90,000, well, now we can see that I'm actually paying tax on more money than I even need. And that's also the other goal, is that we're matching how much income we're paying tax on with the expenses we actually have every year. Again, this is the benefit when we stretch it out over this whole time period. We can build a plan to say, when do we need this money and what amount do we want to pay tax on it? There's some common strategies that can be used. So for example, Roth conversions, that's a big one in this entire timeline that we can play with for people, that we can say, where do we match up the income best in what year? So that's one common strategy. Other ones that we can pair this with are charitable giving. So maybe you like to give to not-for-profit organizations. That's a way, again, to affect this RMD amount. You can decrease the amount of taxes you pay on the money coming out if it's going to a charitable organization. And then even some others, again, if you're a corporate executive, you might have some appreciated stock. Again, we can say, maybe we don't want to pay tax on that, but we want to give that appreciated stock to a charitable organization. What you can see here in this timeline is there's a lot of wiggle room. There's a lot of windows for things that we can do if you're giving it enough time to plan ahead. That's the biggest thing that you want to be thinking for and planning ahead, so that your RMD isn't making a really big dent in the money that you've saved, but rather you're only paying the taxes that you need to, but you're actually choosing to pay it at the lowest rate possible. So if you're someone who's nearing retirement and you're starting to consider how to plan for things like RMDs, why go it alone? Our team is here to help. We specialize in tax efficiency, and we would love to partner with you in your finances. You can reach out to financialdesignstudio.com to get started. And thanks for watching.